Hi everyone. Today we're going to talk about assets for insurance acquisition cash flows and just understanding how this works in terms of allocations for non-transition groups. So I'll do a separate video for transition groups and also a separate video for some implications of consistencies between transition groups. But for this video, we're assuming that no groups are in transition and we're trying to understand what it means in terms of allocating insurance acquisition cash flows and how to determine these assets. So on this page, I have the relevant extracts from the current exposure draft, and you'll see on the left, this side, I have paragraphs 28A to 28D, and on the right side, this is from the Appendix B of the standard. And you can see that this references paragraphs 28A to 28D. So it's as a supplement to some components of it. So let's just have a read about what the main part of the standard requires us to do. So on the main part of the standard, 28A says that an entity applying the premium allocation approach may recognize insurance acquisition cash flows as expenses applying paragraph 59A. Now, what does paragraph 59A say? Well, paragraph 59A says that if you are applying the premium allocation approach for a group of contracts and every contract in a group has a contract boundary of 1 year or less, then you are able to expense all of the acquisition cash flows immediately when you incur them. Okay, so if that's the case, then when you apply the premium allocation approach, you may expense them. Otherwise, the entity shall allocate insurance acquisition cash flows to a group of insurance contracts on a systematic and rational basis, applying paragraph B35A. Now, we'll get into some issues or some industry discussions around this paragraph in a second. 28B, it says an entity shall recognize insurance acquisition cash flows it expects to pay after the related group of insurance contracts is recognized as part of the fulfillment cash flows of the group of insurance contracts, applying paragraph 32A. And B, insurance acquisition cash flows paid before the related group of insurance contracts is recognized as an asset. An entity shall recognize such an asset for each existing or future group of insurance contracts to which insurance acquisition cash flows are allocated. So what this is saying is that if you recognize a group of insurance contracts, then there is no asset that you're holding relating to insurance acquisition cash flows because it's actually bundled up in the fulfillment cash flows, which is part of the liability for remaining coverage for a general measurement model group. However, if you have future renewal groups, i.e. you have insurance acquisition cash flows that you've already paid, but they may relate to a future renewal group, and you haven't yet recognized them because they have not yet incepted, then you must recognize these costs that you've allocated as an asset. Okay, so that's 28B, talking about the groups that you've recognized, what you do to the insurance acquisition cash flows, and the groups that you haven't recognized. Okay, then for 28C, it talks about what you do with the amounts in 28BB. It says, well, looking at the amounts that you've recognized as assets in 28BB, you derecognize these when each groups of insurance contracts are recognized. And we'll go through an example talking about or showing you exactly what this means. In paragraph 28D, it says that at the end of each reporting period, the entity shall assess the recoverability of these assets. So that's these assets here. And then at each period, whichever assets that you have not yet derecognized, you need to assess for impairment. If facts and circumstances indicate the asset may be impaired, the entity shall adjust the carrying amount of the asset. So basically what that means is if it may be impaired, you recognize an expense for the degree in which it's impaired. Let's look at the Appendix B. Okay, so let's look at this bit on the right-hand side. So this says that to apply paragraph 28A, an entity allocates insurance acquisition cash flows that are directly attributable to a group of insurance contracts. To that group, A, and to groups that include insurance contracts that are expected to arise from the renewal of the insurance contracts in that group. So let's look at 28A again. So 28A is here. So it says, now let me just highlight, I just want to highlight that this is referring to the premium allocation approach. Okay, so this is saying in the premium allocation approach, and I just want to highlight another word, it says otherwise. So if you applying the premium allocation approach, and let's just say in one of your contract groups, let's just say you have a group of contracts, oops, undo. Let's just say you have a group of contracts. Okay, so this is group, and this is PAA. And if you have this group, and let's just say you've associated, and I'm not going to allocate anything for the time being, I'm just looking at paragraph 28A. Let's just say you associate insurance acquisition cash flows of 100. Okay, so you're really saying that I've identified 100 worth of insurance acquisition cash flows related to the premium allocation approach measurement of this group, and let's just assume that every contract in this group is less than a year. Okay, so contract boundary less than or equal to 1 year for every contract in PAA group. So in this case, you are able to, under paragraph 59A, write down all of this 100. Now here's the key word. The key word is otherwise. So if you actually read this word for word, what this is saying is if you apply the PAA, then under paragraph 59A, you can recognize all of this if your contract boundary is less than 1 year or less than or equal to 1 year. So let's assume we do allocate that. We do recognize that. That means that disappears because the 100 goes into, or you just earn it. Earned. And no more, because you've earned it completely. You recognize them as expenses. So they go into expenses. Okay. So what are you left with? 0 left. And then what do you do with the remainder? It says otherwise, if you don't do this, okay, you allocate the remainder on a systematic and rational basis, applying paragraph B35A. So that means you allocate the remainder to this group and to any subsequent renewal groups. So that means I'm really allocating 0. So that means none of this applies. And if you're allocating 0, then none of this applies either. And if none of this applies, then it means you don't have to derecognize any assets because none of that applies, and it means you don't have to do any impairment testing. So if you just read the words strictly, then that's what it implies. And as you may appreciate, operationally, it's much more simplistic if you do it this way, because there's nothing that you need to allocate. You don't need to do impairment testing, which is one of the reasons that that will cause significant operational challenges. Okay, so let's go through an example where this didn't apply, i.e. we're not using a premium allocation approach. Let's assume we're using maybe a general measurement model or a premium allocation approach where we don't write on off everything. So now let's go on to this example. So I'm going to draw a little timeline. And let's assume that we have three groups of contracts. So we have a main group. Let's assume it's the group here. And then we have renewal group 1. And we have renewal group 2. Okay, so renewal group 1, and we have renewal group 2, and this is the first group. Okay, so I've left a bit of a blank here and here, just to create a bit of a gap so we know that they're renewals, but really let's assume that there's actually no time between these contracts, they renew straight away. So what paragraph 28A and B35A is talking about is that in this very first group, you must have, the insurer would have spent money to acquire this business, right? So if you imagine a life insurance company, they might actually have to spend underwriting costs equals, for example, medical checks, right? They might have brokerage costs, for example, commissions, just to list a few, to acquire this group. And some of these costs might be significant. So if you think about the life insurance example, usually once these medical checks are done for a yearly renewable policy, then when the contract goes to the first renewal group, they don't go through the same vigorous underwriting again. And when they renew again, they don't go through the vigorous underwriting again. So that implies that these medical checks and brokerage costs are extremely significant upfront. But really, if you have renewals, and this is assuming that, let me write this down, this is very, very important. This is assuming that yearly renewable term, YRT, policies are short term, i.e. 1 year contract boundary. Now, I'll make another video to discuss about whether this is appropriate. But for this example, let's assume that this is appropriate. Okay, just assume that. So under this example, what we need to do is we need to go through and look at all of these costs associated with the first group, and also to help us get the rights to the renewals of groups 1 and 2. So let's assume that you identified that the total cost of all of this as 900. Okay, so let's write that down. $900 total acquisition costs. Okay, so that's 900 there. So let's mark that with the black. So let's assume that this is the whole cost, 900. Okay, so that's the total cost. What this wants us to do is the standard wants us to divide this into 3 buckets. Okay, so the first bucket is under paragraph B35 AA. It's the amount of these acquisition cash flows that relate to the first group. And then these two, under B35AB, these are the amounts that relate to renewal group 1 and renewal group 2. And so let's just assume that we allocate these evenly. So that means that in the first group, we're going to have, and I'm just going to draw it here, 300. In the second group, or in the first renewal group, we're going to have 300. And in the second one, we're going to have 300. Okay. Now, in the first group, let's write this down. First group. At this point in time, if we're standing here, right, 300 that's allocated to this first group is bundled into the LFRC. Okay, so we're assuming that this is going to be the general measurement model. So it's bundled together in the LFRC. It's really a negative liability. Okay, until you earn it. But we have these two, right? We have this and we have that. So we have 600 of asset for insurance acquisition cash flows. And this is held in insurance liabilities as a negative liability, but it's important that this is not held in the liability for remaining coverage. And the reason is because these two groups, we're not providing cover for them yet. So there is no remaining cover because the cover hasn't started. So they're really part of insurance. That's why they're in insurance liabilities as a negative liability, but not in here. And LFRC is a subset of this. Okay, just to make that clear. Now, when we get on to the second group, so now we're standing here. Okay, so let me rub this out. So let's draw that again. So now we're standing in renewal group 1. So under this case, so renewal group 1. Then 300 of the asset is derecognise. Okay, so 300 of the asset is derecognise. So 300 remain. And then the 300 that was derecognized from asset, this is actually bundled into the LFRC as a negative liability. So in essence, the 300 that remains is still similar to this asset, and it's still held in the insurance liabilities and not in the liability for money coverage because renewal group 2 hasn't renewed. And then when you actually progress to the next renewal group, the final 300 is derecognized and there's no more assets left. And as we move from the first group to the renewal group 1 to renewal group 2, what you need to do is at the end of each reporting period, so when we're starting here and there, before the start of the next group, we need to test for impairment. Okay, so basically we're saying, is this impaired? Because what we're saying here, this allocation is saying we expect to recover this from the inflows in group 1, renewal group 1. And if we don't think this is recoverable from the inflows, then it means that this is a cost that we've paid right at the start, then this is no longer viable. And it means if we can't recover some of this or all of this, then all of this must be recognized as an expense immediately because we didn't recognize that as an expense in the beginning, even though we paid for it. And this impairment test is also done here as well. Impairment. And this impairment test is done at 2 levels, but we're not going to go through those 2 levels in this video. This video is just trying to demonstrate how this allocation works. Okay, so how we started, if I move back to this asset for insurance acquisition cash flows, well, we started off by saying this premium allocation approach, if you're applying the premium allocation approach, then maybe you can write everything off and then you have nothing to allocate. But if you don't do that, then you need to first recognize any acquisition costs that you've attributed to that group or allocated to that group in the LFRC, the liability for remaining coverage, and any ones that you've attributed to a future renewal group, you recognize as an asset. Okay, so that was done here, right? We've taken the 900, we've attributed some here, that was B35AA, and then we've allocated the 600s into 300 blocks, and we've recognized these as assets. So if we go back here, then this is saying you derecognize the assets, 28C, at the recognition of each group of contracts. So we did that here. So we're saying when we recognize this group, so in the midst of renewal group 1, when this actually starts, we derecognize a 300 and there's 300 that remain. So that's 28C, and this impairment testing is done at the end of each reporting period. And if facts and circumstances indicate the asset, if facts and circumstances indicate that the asset may be impaired, the entity shall adjust the carrying amount of asset and recognize this applying 35B, okay, which is this component over here. So we're not going to go through B35C. It just basically means if you thought it was impaired and it's no longer impaired, then you can reverse some of this. But the main part of this video is to demonstrate that insurance acquisition cash flows need to be allocated, and providing a simple example of what this means in order to allocate these insurance acquisition cash flows, and some of the potential issues that are right now being discussed in the industry, which is the issue relating to 28A. So can we do this? Can we do that? Because does that go against the principle of allocating the acquisition cash flows to the right places? So not sure yet, but maybe we'll find out in the future after a few rounds of industry discussions. So I hope this video added some value to you today, and I will leave it there. Have a nice day and don't forget to smile. See you next time.